Welcome back to our intermediate financial accounting class. In our last few segments, we've been talking about inventory, and we've talked about a lot of stuff with inventory. We've talked about why it's important, lower cost or market write-downs, basket purchases, estimating ending inventory, and we've done lots of tables and examples and numbers, and we got into the middle of our last example and realized we'd gone so far that maybe it was time to stop and regroup and think about it before we moved on. And that's where we're going to pick up right now. Remember, under the retail inventory method, there are four main steps. The first of which is to calculate your ending inventory at retail. And we did that in our last segment, and it looked like this. A pretty big calculation to get to just one step. But again, remember, this one step is the same for all of the different retail inventory methods. So it's okay that it takes us a little time, because once we get the hang of it, we're good for all four methods. What changes, and remember this was a key concept, was understanding these steps and what changes between the flow assumptions, LIFO, FIFO, weighted average, lower cost of market, etc., is just which numbers from this table we choose to use. So let's start with the most common, and that's the average cost method. And under the average cost method, I take my cost of goods available for sale and I divide by goods available for sale at retail. So average cost, my ratio is cost of goods available for sale divided by goods available for sale at retail. That's one method. The next most popular method is the lower of cost or market method. And with that one, I again use cost of goods available for sale, but now I do it after my markups. So to do lower of cost or market, also known as conventional, you'll see that sometimes, conventional. I take my cost of goods available for sale and I divide by goods available for sale at retail after markups. Now you notice this number is bigger than the 1.8 million. Which means it's going to give me a bigger number at the bottom, gives me a smaller ratio. Smaller ratio gives me a smaller ending inventory estimate. Smaller ending inventory estimate gives me less on my balance sheet and a higher cost of goods sold on my income statement. That's lower of cost or market. If we're going to use FIFO, I change it again. For FIFO, I don't care about the beginning numbers. So these numbers have to go away, because I assume under FIFO that I sold those first. They're gone. They wouldn't be part of ending inventory. So for FIFO, I'm going to take cost of goods available for sale minus beginning inventory at cost. And I'm going to divide by my goods available for sale at retail minus my beginning inventory at retail. So the ratios change, and calculating the ratio, well, that's step 2 of the process. And then once I have that ratio, then I multiply this 251,304 by the ratio, and that's my ending inventory number under the retail inventory method. Let's take a look at one of them so we can see how it works. So let's start with average cost. So step number 1 under average cost would be to get my ending inventory at retail. And we calculated that. It was 251,304. That was from our earlier table. Step number 2, I get my cost to retail ratio. And in this case, for average cost, we said it was cost of goods available for sale divided by goods available for sale at retail. And I know these numbers, they're also in the other table. This was 1,100,232, and goods available for sale at retail was 1,811,304. So I get 0.607 or 60.7%, which lets me do step 3. If I take my ending inventory at retail times the percentage, or the ratio, I get my ending inventory at cost. We've thrown a lot of numbers at you at this point, but let's take a look. Before we do this last calculation, let's just think about what we're doing. What we're saying is, look, we had on hand retail value $251,000 and change. But that doesn't do us any good. I can't put that on my balance sheet because that's not what I paid for it. That's what I can sell it for. So somehow I've got to turn what I can sell it for back into what I paid for it. How do I do that? Well, let's deflate it. If I know that my cost relative to my retail value, that's what we're looking at down here, is about 60.7%, then what I'm saying is for every dollar of retail value, there was about 61 cents worth of cost. So I can take that 251,304, I can multiply it by the 60.7%, and that's going to drop me from a retail value to a cost value. That's what I'm doing. And if you want a picture, because we've done a lot of pictures in the past, this is what I charge people. It's the retail value. It's the sticker price. Of that sticker price, what I'm saying is this 60.7% is what I paid, and the rest would be my gross profit. That's what I'm doing. All I'm doing is figuring out this percentage so that I can take the number that I know and turn it into the number that I need. And if I need to, so that I can finish my income statement, I can take cost of goods available for sale minus ending inventory, and that will give me my cost of goods sold. I can do it here, I can do it in the income statement. Cost of goods available for sale I have up here. So my cost of goods sold will be $947.90. I could go back to my table, and my sales value was $1,560,000. I can subtract out that $947,890 and give you gross profit. I've got everything I need. I can move forward with my income statement. We're going to stop here for a minute because I want you to try this method with these other two inventory flow values, lower of cost or market and FIFO. So using the ratios that I've given you that you can see up here on the screen, please do the calculations, and then when we come back, we'll talk about them briefly, and then we'll do LIFO together because that's the most exciting of the bunch. I'll see you then. Thanks.